Welcome all participants to the Marmor webinar series. This is Rajesh here. I work as a senior analyst with Marmor. Marmor is a majority-owned subsidiary of Kuwait Financial Center Markaz. Established in 2010, Marmor has developed full-fledged research capabilities covering multiple areas such as infrastructure research, economic research, capital market studies, policy analysis, and the like. Focused on the MENA region, Marmor is focused on serving the interdisciplinary knowledge needs of its clients and stakeholders. Questions, if any, could be asked anytime during the course of the webinar and shall be addressed at the end of the presentation. Alternatively, you're free to email across your questions. Recording of this webinar will be sent in a day or two, and the same shall be uploaded in the Marmor website and YouTube channel. In today's presentation, Forecasting Sovereign Debt Issuance in GCC, the presentation is split into three parts. In part one, we'll be dealing how the financial position of the GCC government has changed in the environment of lower oil prices. And in the second part, we'll be dealing the responses so far made by the GCC governments and its consequent impact on the banking sector, debt market and the capital markets. And in the final part of the presentation, we'll be estimating the amount of sovereign debt that will be issued in the coming years. And this is just the executive summary of the presentation. The persisting lower oil prices has presented a very challenging environment for GCC governments. It has not only led to loss of revenues, but it has also constrained the fiscal pressures by flipping the surplus into deficits. Though some of the governments have been very active in the domestic debt market, especially Saudi Arabia, they have been facing a lot of government debt with the local banks. The banks may not be able to act as a sole source of funding in the coming years. So this entails looking for alternative sources of capital, especially international bond market, or maybe trimming out the government stakes. Maybe that's the eventual fallout of Aramco IPO. And due to lack of proper debt management policies from the government side, it has different analysts has come out with different opinions regarding how exactly they'll be funding the deficits. And in this presentation, we estimate the amount of sovereign debt issuance through two methods. One is the budgetary numbers which have been provided by the GCC governments for 2016, and through fiscal deficits which are provided by the IMF. And we estimate the GCC sovereign debt issuance to be in the range of approximately $300 billion to $400 billion on a cumulative basis until 2020. This could be either in the form of domestic debt or international debt or syndicated loans. This flurry of activity in the fixed income space in GCC, which has so far remained very dormant, could present investors with widespread opportunities. We'll also be dealing what exactly these opportunities are and what are the various advantages and disadvantages of GCC bonds. These are the three different pillars of our presentation today. We'll go ahead with the first section of the presentation. So as everyone is aware of, oil prices have fell drastically. It has almost fell by 70% since the mid of 2014 for various reasons. One is due to the oversupply situation. A lot has been attributed to the US shale revolution, and also the demand has been moderating, especially in Eurozone and China countries. And we have the OPEC producers, which almost account for 30% of supply. They have been very reluctant to freeze the production, nor reduce the production levels and curb the excess supply in the market, leading to enormous pressure on the supply side pressures and resulting in the fall of the oil prices. Oil prices, as you can see, are currently hovering well below the $50 per barrel. And you can see the fiscal break-even prices over here. The fiscal break-even prices for most of the GCC countries are much higher than the persisting oil prices. So this has some important implications, as GCC governments almost 80% of their revenues are derived from oil by selling the oil, crude oil. Their fiscal position from a surplus has been converted into deficit, and as you can see, compared with 2012, to 2016, the revenues have fell by almost 40% due to the fall in oil prices. Also, the fiscal balances, which were in surplus in the tune of USD $200 billion, have flipped into deficits, and this deficit situation is expected to persist in the short term to medium term, that is like 5 to 7 years. And the deficits is entirely expected to wipe out the reserves for various countries depending on the existing reserve level. And in this section of the PPT, we'll be discussing about the responses made by the GCC governments and how it has affected the banking sector, the credit markets, and the debt markets. GCC governments, though they have taken a lot of initiatives to diversify the economy, those measures have not been fruitful, and most of their activity has been in work in progress. To tide over the budgetary deficits, KSA was very active in the domestic debt market in 2015, and most of the sovereign wealth funds have also altered their portfolio in favor of liquid assets. This is much evident in the activity of Qatar sovereign wealth fund, wherein they started liquidating some of the office properties and they reoriented the portfolio structure towards more liquid assets. This, we believe, though the motive has not been clearly stated, this we believe is a contingency measure to tide over any fund deficits. And GCC governments, they follow the broad framework to tide over the budgetary deficits. One, they have been trying to increase their revenues. Various revenue augmentation procedures have been discussed. One is like introduction of taxes. Though it's anathema to the GCC region for introduction of any taxes, recently GCC-wide framework for implementation of value-added taxes, that is VAT, has been introduced, and VAT is expected to be introduced in 2017 or 18 at 5% rate. And despite this introduction of VAT, we believe that it could at best augment revenues to the tune of 1.5% to 2% of the GDP, and it may not be very helpful as hydrocarbon revenues still dominate the revenue source at 80%. And alternatively, GCC governments have also been trying to rationalize the expenditures. We have been hearing talks about the fuel prices being made in line with the international prices, removal of subsidies, capping up of wages, and the like. So this has been the response so far from the GCC governments. The GCC governments, depending on the existing reserve levels and the underlying economic structure, they have been actively involved in various policy debates to introduce further reforms too. A lot of analysts have been opinion stating that GCC countries as a whole have very low debt level, and even in case if they have fiscal deficits, they could increase their debt level and tide over the problem. But the major question is, this could ideally happen when the lower oil prices exist for like maybe 6 months or so. But in this current situation, wherein the oil prices have been much lower than the fiscal break-even prices for a sizable amount of period, say for 18 months, and even with most of the international agencies like IMF and World Bank expecting the oil prices to be around $50 per barrel or $60 per barrel, this situation may not be persisting, as we have seen in the sovereign ratings, which are being constantly downgraded and kept on further watch. This chart specifically says about the current reserve levels being held by the various GCC governments. As you can see, UAE is well placed in comparison with the other countries. One can say Kuwait and UAE, which have reserve assets which are almost 10 times the expenditure, or much placed to weather this period of low oil period, while countries like Oman and Bahrain, which have like very few assets, even KSA, despite the absolute value being much higher, if you consider in relationship with the expenditures which they have been doing, it's much lower and could probably last 3 years without any additional sources of revenue. And these are the implications which we have been seeing currently in the banking markets. Due to the lower oil prices, the governments have not been able to generate revenues as much, and most of the government entities, they're also facing a revenue shortfall, and due to lower realization of petrochemical products, their profits also are being hit, and as a result of it, the deposit mobilization process in the banking has also hit. If you see, the deposits have been clearly on a downtrend, and very recently in the last few months of 2015, it's almost the growth has been on the negative territory. And not just the deposits which are hard to come by, it's also the money supply which is on a decreasing trend. And this leads to significant pressures on the liquidity front. We have been hearing various media reports stating that the pressures have been very acute. And if you see over here, the 3-month interbank rates have literally shot up in the past 6 months. For instance, in Saudi Arabia, it has almost doubled, and almost on average, the 3-month interbank rates have increased by 40%. This is mainly due to the fact that the GCC governments have been very active in the domestic debt market. If you can see, the red bar graph depicts the sovereign debt issuance. In the past, during the global financial crisis, the governments accumulated, they issued debt and they boosted up their reserves. Currently, I mean, it's also the same situation. In 2015, you can see the spike again in sovereign debt issuance. And this sovereign debt issuance currently being done only in the domestic debt market, and which means that the banks have been subscribing to the government bonds, and this has placed a lot of pressure on the interbank money rates. And it's not just the banking sector and the money market which is feeling the pressure. We can also feel the signs of pressure are also evident on the credit markets. If you, as evidenced by the CDS spread, the credit default swap spreads for various countries like Saudi Arabia, Bahrain have almost doubled in the recent period, right from the June 14 when the oil prices started to fall to the current period. This is a sign. This is also in part due to the fact that the rating agencies have constantly downgraded the sovereign ratings of various countries, especially Saudi, Oman, and Bahrain. This has been the situation. Saudi has been downgraded by almost like 2 notches, and Bahrain, which commanded the investment grade rating of BBB, is currently rated BB, which is junk status. As you can see, Bahrain is the only country in GCC whose government bonds have moved from investment grade to junk. Oman is also not faring, is not in a better position. It's just a notch above the junk rating at BBB minus, while countries with higher level of reserves such as UAE, Kuwait, and Qatar ratings have been retained, though they are on continuous watch by the GCC, by the rating agencies. While this being the case, we'll now see how much of a debt would be issued by the GCC sovereigns and what are the opportunities and challenges of such a move. Apart from UAE, most of all other GCC countries had forecasted a budgetary deficit. This is because they have been continuously maintaining the expenditures. While on the revenue front, due to the fall in oil prices, they have been very pessimistic on their oil price assumptions, and there are not much other avenues to raise revenues on an immediate basis too. As a result, the budgetary deficit stands at $150 billion in 2016 for GCC on a cumulative basis, while some of the countries like Qatar and Oman have been very explicit in stating how exactly they intend to fund their budget deficits. Countries like Bahrain and Saudi Arabia have not clearly indicated how exactly they like to fund the deficits. However, there have been various indications from the finance ministry, comments made by the finance ministry, and various news and media reports stating how exactly they intend to fund their deficits. And based on our own research with regard to the current existing debt levels and the reserve levels which they have, we have made a calculated assumptions regarding the level of international issuance which the countries will be taking, the domestic issuance, the expected loans, and the amount of reserves they will be utilizing. And based on the budgetary numbers, we predict that the financing need for the country is for GCC as a whole, as a region, they would be needing $150 billion, of which we believe 50% will come from the reserves and 58% will be funded by the reserves. Out of all this, Saudi Arabia has the most the most maximum need at $44 billion of debt, which they will be taking. The rest of the countries have minimal debt. Though Bahrain and Oman have like only $4 billion of debt, this is much higher in comparison with their GDP levels. Saudi Arabia is a much bigger country. Even 44% accounts for very minimal percentage of their as a GDP. And in the second methodology, we use the fiscal deficits to estimate the amount of debt which they will be taking. I mean, the numbers have been taken from the IMF estimates at the IMF outlook of October 2015. And if you see over here, we have back calculated the estimated debt level to see if it actually makes sense. As we have said, Saudi Arabia, which should be incurring a debt of $42 billion, it's they currently have a 6.7% of GDP, and even if they take like $40 billion of dollars, the entire debt stock would come roughly to 16% of their GDP. Well, this is not the case for Oman and Bahrain, which even if they take like $4 billion of debt and $6 billion of dollars of debt, their debt stock is already higher, and since their GDP is much smaller, Bahrain debt level would rise from 66% to 77%, and even in the case of Oman, which is at high single digits from 9%, it could shoot up to 20%. While in the case of Kuwait and UAE, which ideally doesn't require any debt, since it could be easily funded through reserves, their debt levels are expected to fall. We have also calculated based on the current reserve level, countries which try to utilize their reserves, especially UAE and Saudi Arabia. For UAE, since the assets are much higher, they will probably utilizing 1% of their sovereign wealth, while for Saudi and Oman, it could be up to 10%, which we believe is necessary to tide over the current situation, which is unprecedented. And since the fiscal deficit estimates are available until 2020, we have tried to calculate the sovereign debt issuance until 2022. Since most of the GCC governments have not provided clear policy indications of how exactly they intend to finance their deficit in the coming years, we have made our own assumptions based on 2016 numbers. We believe at best the reserves could fund 40 to 50% of the deficit. The rest we believe would be funded by debt, or when I say debt, it could be a mixture of bonds and syndicated loans. So cumulatively, if we see GCC countries have a deficit of almost $680 billion from 2016 to 2020. And when we assume like the 40% to 60% of it would be financed by debt, it would roughly come around anywhere between $300 billion to $400 billion. And this is just the indicative chart stating how much of a debt level could increase. If you see, until 2014 or even 2015, there has not been much of activity from the sovereigns in the GCC debt space, but the situation is expected to totally alter in the coming years until 2020, and we can see a whole lot of debt being placed in the governments. Okay, now we have seen that the GCC governments are expected to take on almost $300 billion to $400 billion of additional debt. So what could be the expected pricing which the sovereigns could expect in case if they're going to tap the international debt markets? And we have various ratings for the GCC governments, and based on the ratings, we can easily calculate how much of a spread they would be commanding in case if they go ahead with bond issuance. For countries like Oman and Bahrain, which has recently been downgraded to junk status, the spread over the US Treasury is expected to be somewhere between 400 to 500 bips. While for countries whose ratings are unaffected, such as UAE, Qatar, and Kuwait, they could easily raise bonds at a much lower rate of probably just below 3%. And these are the recent activity by the GCC sovereigns. We can see Saudi Arabia has been very active in the domestic market. They have been issuing T-bills in the domestic market. They have been placing their domestic debt with the local banks. Well, countries like Bahrain, whose rating was recently downgraded, they had to incur higher charges. As we have said, Bahrain, which recently raised a 10-year bond for 1 billion, had to pay almost like 7.5%. Well, Qatar, which commands a very good sovereign rating of AA, could easily raise a $5 billion dollar loan, just a spread of 90 bips over Libor. These are some of the banks which have been involved in the recent issuance and the past issuance. You can see among the regional banks, Gulf International Bank and QNB have been very active, while in the international bank which have been very active in the ranges of Bank of Tokyo, Mitsubishi, Citi, JP Morgan and HSBC. So one may expect these banks to further help the GCC sovereigns in mopping up the capital to tide over their deficits. And what essentially is the difference between domestic issuance and sovereign issuance? One, in case if the governments are going for domestic issuance, it could be done in a easier and faster way. And it could also help in the development of the local debt markets, as it would help in establishing the yield curve. But one of the primary disadvantages, whenever the sovereigns go for domestic debt market, it's expected to crowd out the private borrowers, as we have seen in the last quarters of 2015, and it could place some additional liquidity pressures, leading to increase in the interbank rates. While foreign issuances, if we consider the big ticket issuances are possible, and also when the sovereigns go ahead and mop up capital in the international bond markets, they could do so in dollars, and it would be very useful to add on to their forex reserves, which is very essential whenever they face some pressures in the currency peg front. While on the flip side, it could lead to greater scrutiny and the government finances, and also it could incur additional charges wherein the governments have to prepare themselves for various road shows, arrange with the bankers, and the process is time consuming, and maybe at max it could take some two quarters or probably 6 months. And as an investor, what could this mean? One, GCC bonds, we believe, have a higher risk return profile than developed and emerging markets. This is because GCC bonds have very unique characteristics. GCC region is a high growth region, and the current low debt to GDP ratio and the bonds which are being backed by sovereign wealth could offer a lot of capital protection on the downside. That is not to say that, I mean, these countries may not default. There is always a scope for default, but then we believe the risk return profile is much more attractive. And also, since the currencies are pegged to the US dollar, it could avoid, as an investor, one could avoid the currency risk. For instance, various LATAM countries such as Mexico and Brazil, despite their governments offering like 14% or 12% of returns, due to depreciating currencies, the investors, especially the international investors, had to forego a lot of returns. But this is not so the case in GCC government. And on the flip side, the continuing geopolitical risk in the region and the existence of lower oil prices, which no one knows for sure when it would exactly rebound, could affect the GCC bond performance. And the opportunities for the GCC governments, in case if they're going to take on additional debtors, it would ensure a disciplined budget going forward. Maybe we could see a lot of expenditures on the capital side rather than the current side. And as an investor, the introduction of GCC sovereign bonds is helpful for him in diversifying his portfolio, as it is lowly correlated with the equities. But a lot of steps needs to be taken to have a very active fixed income market or debt market. One is establishment of debt management office and regulatory framework. Some of the countries have been doing this. The regulatory framework for sovereign issuance has been is in progress, and they also need to come out with very clear policies regarding how exactly they propose to fund their deficits, and they need to regularize their sovereign issuance, and communication in this aspect is very crucial, especially in the case of countries like Saudi Arabia, which has been so far remained very stable. With this, we come to the end of the presentation. Questions, if any, could be asked now. Thank you for attending this webinar. We have a question from one of our participants. On what basis have you estimated the level of international debt issuance for each of the countries? As I said, I mean, the GCC governments have not been very clear with regard to the way in which they intend to fund their deficits. We have relied on various commentary made by the finance ministries and international media reports on those basis, and depending on the prior experience of the GCC governments in 2003 when the oil price crashed, we have estimated the international debt issuances. I hope that answers your question. There has been one other question. It says like, why has the sovereign debt issued by the Saudi Arabian government has been offered only to banks and not to other institutional investors such as insurance company, PE and other retail investors? Currently, I mean, the debt market, the local debt market issuance by the Saudi government was done in a bit of a haste. So, I mean, so what essentially they did is they didn't have proper debt framework in place, and they had to rely on very quick access to capital. When in such a situation, banks were the most viable candidates, and since they have also a requirement to hold government debt as part of their, to enhance their liquid assets, they were considered to be one of the right candidates, at least the initial stages. And since the ticket size was also high, I mean, it couldn't be offered to retail investors. But we believe with this issuance, a whole lot of activity could happen in the future years, wherein the sovereign debt could also be accessed by retail investors and other institutional investors. But in 2015, which happened due to the fallen oil prices, a very urgent or emergency need was there. Due to that reason, only the banks were considered as the ideal candidates. But going further, since the issuance would happen, which we estimate to happen for the next 5 years, other institutional players could also be roped in. Thank you for attending the webinar. With this, we come to a close. The recording of the webinar will be sent in a day or two to all the participants, and the same shall also be uploaded in the Marmor website and YouTube channel. Thank you.